Hello, my name is Jeffrey Smith. I'm the Chief Instructor here at DTI. I want to talk about what options are. First of all, there is risk in trading. You can lose money. Past performance is not indicative of future results. And of course, if you can't afford the loss, do not take the trade. First of all, an option is a trading vehicle that gives the right but not the obligation to engage in a future transaction on some underlying security. Now, all this is saying is it's giving us a right, but not an obligation. It's kind of like voting here in the United States. As long as you're over the age of 18 and not a criminal, you have the right to vote. You don't have to go vote, but you do have that right to do so. So when you're purchasing an option, you're purchasing that right, and of course, you are looking forward to engaging in some future transaction, whether you're going to sell it at a different time or you can exercise your right. But this is on some underlying security, security being a stock or a futures contract or some index. So that's what they call the underlier. An option contract is a contract between a buyer and a seller. If you think about the market, there are only two types of people. There are buyers and sellers, or there are bulls and bears, right? So this contract is going to be between a buyer and a seller, whereupon the option holder's choice, that is the buyer, to exercise that option, the party that sold it to you or wrote the option must fulfill the terms of the contract. So if I'm the buyer of an option and I want to exercise my right, the person who sold it to me must fulfill that transaction. It's much like going out and buying a house. If you go out and take out an option on a house, if you will, say you want to buy someone's house but you can't do it right now, you might pay them $1,000 to hold it for 30 days so you can go back to the town you're coming from and gather your belongings, quit your job, whatever, move to the new city, and then you can exercise your right. You paid them $1,000 to purchase the house at a specific price. You exercise it. However, if your company offers you more money, you decide to stay, you call the person up and say, hey, I'm not going to exercise my right to buy your house. And so they get to keep your $1,000, right? So basically, that is an options contract. You're buying an option contract to purchase something. So, but the person who sold you that contract is obligated to sell their house to you if you want to exercise your right. And that's basically what this option contract is doing. If you purchase an option, you're purchasing the right to buy something. And if you're purchasing the right to buy something, then the person who sold you that right must fulfill the terms of that contract. So let's talk about those contract terms. An option contract has a specified price on it called a strike price. This is the price where you strike the deal, which the underlying security can be bought or sold. But that's where you strike your deal. So every option contract will have a strike price. The contract has an expiration on it, at which time, if nothing is done, in other words, if you don't exercise anything, it will become null and void. So if nothing is done on that contract by a specific date, well then no action is taken and the contract goes away. And of course, the contract will control 100 shares of stock or the underlying security, unless it's otherwise specified. If you're doing options on futures, it'll be one contract. If you're doing a house, hopefully it's not 100 houses, right? So it will be one house. So it all depends on what the contract terms have in them. And that's basically what an options contract is. In the next video, we'll talk about how much options cost. Thank you.